Let's analyze MicroStrategy stocks now, especially since a 10-for-1 stock split is coming soon. The most important aspects to consider are the support levels at $2,000 and $2,200, which are significant with a large volume at these levels. Could the stock actually reach such a price? It is quite realistic. However, I also want to draw your attention to the open interest in options at the $3,800 level, indicating another potential 100% increase. But we'll discuss this later when I explain how support and resistance levels work in the derivatives market. Let's start from the beginning. As we know, MicroStrategy stock has risen by 320% since the beginning of the year. This is absolutely normal because the company holds Bitcoin on its balance sheet, and Bitcoin has also increased by a similar percentage since then. After that, there was a significant drop of 50%, followed by a rise, and for the last 3 months, the stock has been in consolidation, not moving much. I also remind you that the company holds Bitcoin in its accounts. Let's look at the correlation between Bitcoin and this company. As we can see, until 2024, the correlation was almost 100%. When Bitcoin rose, the company's stock followed suit, and vice versa. However, in March, there was a divergence, and MicroStrategy's stock grew much more than Bitcoin. The current discrepancy is almost 80%. What does this indicate? It indicates a lot, and I will return to this point later. But first, let's consider the volatility. Again, I emphasize that a stock split is coming soon with a 10-for-1 ratio. This means the stock price will be reduced by a factor of 10, so it will cost around $178 per share, and you will have 10 times more shares in your account. Now, let's move on to volatility. As we can see, volatility has been gradually decreasing due to some consolidation. However, recently, volatility has started to rise again, which is also related to the growth of the company. We see that volatility has reached levels between 90% and 100% across different expiration dates. Next, let's look at the volatility smile. What is happening here is quite interesting. The volatility smile is more skewed towards put options than call options. This indicates that investors and traders are anticipating a decline in the stock more than a rise. This is actually a normal situation because when traders buy stocks, they hedge these stocks by purchasing put options, which is why put options are usually more expensive than call options. Now, let's examine historical and implied volatility. The gray line represents historical volatility, while the white line represents implied volatility. Currently, volatility is roughly at the same level across different expiration dates, with slight variations. On average, the volatilities are approximately equal. Why am I showing this? Because trading volatility can be much easier than trading the underlying asset itself. The reason is that we have reference points historical volatility. Volatility always tends to return to its historical values, which is why trading volatility is typically simpler. How is this done? I can show you an example so that my words are not just theoretical. I'll demonstrate a couple of interesting strategies for trading volatility. Let's set the date to September 20th and assume that volatility will increase by 15%. Artificial intelligence can suggest various strategies for increasing volatility. Let's look at one of these strategies. It suggests buying a put option with a strike price of $1,800, buying a call option with a strike price of $1,820 for September, selling a put option with a strike price of $1,800, and selling a call option with a strike price of $1,800, and selling a call option with a strike price of $1,820 for October. Indeed, to capitalize on volatility, one must use options. There is no other way to achieve this. This strategy is extremely complex, involving the use of both put and call options, as well as different expiration dates. It is highly sophisticated, but if managed correctly, it can be very profitable. I do not recommend you to start using it right away. I am just showing how it can be done. Now, let's look at the most important aspect, the trading volume of options and open interest. What is happening here? We see a very large volume concentrated at the $2,000 level, which is probably the nearest target. We might reach this level, and after that, a more significant correction could begin, unless we break through this level or Bitcoin continues to rise even higher. Therefore, we must closely monitor this level. Next, let's examine the open interest in options. As we can see, the levels of $2,000 and $3,800 are significant, particularly for call options. I suspect that the $3,800 level is related to the $100,000 price target for Bitcoin. Many people expect Bitcoin to eventually reach this aspirational price. This could happen, and I do not rule it out. If Bitcoin reaches these levels, MicroStrategy stock will likely increase to $3,800. However, I am skeptical that Bitcoin will rise to $100,000 in this rally. as I anticipate a recession towards the end of the year, which would likely cause Bitcoin and other assets to drop significantly. Thus, I would not place strong bets on the $3,800 level. Now, let's consider the market forecast for this stock. As we see, the market predicts that by September, the stock will average around $1,500 to $1,600, indicating that a minor correction is likely to occur. However, the market currently factors in all available information reports, financial data, and volatility. A new earnings report for this stock will soon be released, and the market will adjust accordingly. Looking at the forecast for the end of the year, the market leans more towards a decline in this stock, predicting it will fall to around $1,200 to $1,300. This is a significant drop of about 30%, which is what the market and I predict. Now, let me remind you of my trading strategy. I don't predict where the stock will go. I focus on managing positions and portfolios using risk-reward ratios and mathematics. This means my main task is to manage the position effectively. While it's possible the stock could rise to $2,000, I wouldn't buy it right now because the risk-reward ratio is not favorable for investors. The stock could rise by $2,000 to $2,200, but it could also fall to $1,200, which is a larger potential loss. This suggests that while the stock might increase, I cannot buy it based on my criteria, as the risk-reward ratio is not in our favor. My forecast aligns with the market. The stock might rise slightly in the short term, but will likely face a significant decline afterward. This will depend on Bitcoin, whose price movements are even harder to predict. Now, let me explain what I mean by effective position management. Here's an option strategy I built. If the stock reaches $2,400, we could make $58,000. If it drops to $1,400, we could make $42,000. Essentially, no matter where the stock goes, we profit. Even if the stock rises to $3,000, we still make around $10,000. This approach ensures that we are prepared for various outcomes, capitalizing on market movements while managing risk effectively. So what I'm saying is that no matter where the stock goes, we make money. This is what is called effective position management. I do not predict price movements. I don't know where the stock will go. I build strategies in such a way that no matter where the stock moves, I make money. That's the secret. However, this strategy is complex because it involves selling options. The strategy looks like this, and I absolutely do not recommend anyone to open it because it requires management buying options at the right moment, selling options, hedging risk. This is complex management. I am just showing you hypothetically what can be done here. Now, let's look at the 3D volatility. I often show this as it contains all the information about volatility, options, strike prices, and expiration dates. Professionals often use it to build effective strategies. Additionally, I want to remind you about the importance of unexpected events. If, for example, Bitcoin suddenly drops by 30% over the weekend, the stock could plummet sharply, and we might see a 50% drop in pre-market trading. This could severely harm you if you are using leverage. I would not recommend using leverage for such a stock at all. This is critical to remember. If news about Bitcoin causes it to drop sharply, this stock will also fall significantly. I also remind you that the earnings report and stock split are coming soon, and we will definitely monitor these events closely to see where the stock heads. Additionally, I have launched a real portfolio where I manage positions and explain how it's done. Be sure to watch the latest video and feel free to ask questions in the comments. Good luck to everyone.